Welcome to the Movie Markets Podcast. I'm J.R. Gondeck, and as always, joined by David Sokolovsky. David, let's review July, quickly because I think the first week or so of August, market dynamics have changed quite a bit, and kind of recap that and a look ahead to the rest of the year.
Sure. Thanks, Jared. So kind of like you pointed out, month of July was mostly undone in the first couple of days of this month. And you had the S&P that was up about 1%. So again, kind of a slowdown in the growth there. Whereas you had small cap, which had not really done much for the entire year, up 10% in the month of July. And again, in the first couple of days of August, that trajectory is, reversed course. Small gave back essentially all of the gains that it had made last month and for the entire year. And then you saw, a couple of different things that I think are of note. You saw value outperform growth, which again is something that to be mindful of as you see changes within the market, as you see a shift in the market dynamics, and really, looking for value. And then you saw some international weakness as well, and that's where you had the carry trade that many folks, heard about, where essentially people were borrowing yen at a very low rate. They were using that money to invest outside and further pushing the yen lower. But as that trade reversed, you saw a lot of pain in the Japanese equity markets and saw, a very large one-day drop approaching about 13%. So over the course of the month, you saw concentration risk within ETFs, continue to build and somewhat come to a head at the end of the month. You still see some of the challenges with commercial real estate and showing signs of slowing down. And then you saw, some challenging economic data that had come out at the end of last week, focusing on labor, focusing on employment, and the state of the overall U.S. economy, which is where you saw some concern. So I don't know if you want to dive into some of the challenges that we saw there, the tools that the Federal Reserve has to address those challenges, and kind of how they will prioritize their strategy moving forward.
Well, David, the Fed's full focus is on the Fed for a while now. In last week's meeting, they didn't cut interest rates. I think if they could have a do-over based on some of the recent data, maybe they would have taken a different action than holding interest rates steady. And when you look at the Federal Reserve, there's generally a dual mandate: control inflation. So if you look where inflation is, for the most part, it's hard pressed to see inflation picking up. The trajectory is very favorable overall, which is a good sign for the overall economy. And when you look at whether it's all items on CPI or all items less food and energy, the trajectory of inflation is lower. We have another inflation print expected next week in the 0.2 range, and then you're likely to see some big roll-offs, the following 2 months. So you should be fully in the low twos, overall. So the Fed has done their job on inflation. The debate within the Fed is, do you wait to confirm that you're in the low twos, or is this trajectory strong enough? And when you look at the labor market now, you get a little bit of a mixed picture, which we've been talking about over the last few months. There's two surveys within employment. You have the household and the employment overall. And when you look at both of those, both of them have continued to rise since the pandemic. The challenge is within the household survey versus, overall employment. Overall unemployment, we've created, year to date, close to 1.2 million jobs. But within the household survey, it's a different picture. It's very flat. Only about 100,000 jobs have been created within the household survey. And it brings up a challenge within the labor market. Is a strong labor market or a weak labor market? And then when you look at the challenge, overall, there's been a lot of discussion around the SOM rule recently. And what that is from basically a 0.5% increase in the unemployment rate. And the reason it's had a lot of discussion recently is there's typically a recession either imminent, in the middle of, or soon to follow thereafter. And when you look at the challenge on this graph, unemployment was, as low as 3.4%. It's currently 4.3. So within the parameters of the SOM rule, this would suggest we're in the midst of a recession or there's one imminent. And, that's one of the challenges facing the Fed and the market volatility recently is there's concern about the economic slowdown with the labor market, seemingly slowing down. Although, like I said, you continue to have this mixed picture between the household survey and the overall, kind of job market. So when you bring it back to the Fed challenge is, what do, right? As you look at the overall economy right now, things still look steady and overall pretty strong. But when you look at the trajectory ahead, that's what the markets are more concerned about, because the stock market's always forward looking, worried about the recession before it happens. Typically, by the time you see the headline for recession, stock prices have already started to rise. So that's really the challenge, David, looking at the Fed overall. They're really in a tough spot. This market volatility, and concern about the recession and slowing economic data, kind of begs the question on what should the Fed do and when.
Yeah, so Jared, kind of looking at some of that economic data, and again, labor has been one of the critical components. We've talked about that, over the last several months and have kept a close eye on that. We are a consumer-driven economy. Labor becomes very important, as if there's a perception of a slowdown or the reality of a slowdown, consumers then look to spend less and they look to rebuild their savings. They look to delay large expenditures or large purchases, for example, for buying a house. But one of the things that I think, Jared, that we've talked about is, just the labor and wage inflation. And as we talk about the different surveys, there's some additional information to look at, right? So one is, you've seen the wages and salaries, they continue to increase, right? You had a brief dip during COVID, then there was a resurgence in wage inflation, and that was a big driver of overall U.S. economic inflation. But then you see the wages and salaries start to come down, and really from 2022, the growth, so the dollar numbers are continuing to go up, but the pace of inflation went from over 5% to just over 4%, and looks like it's on a downward trajectory. And the reason for this, as you kind of think about what this is telling you, and as you look at some of the jobs figures, especially if you look ahead, kind of like you pointed out, JR, with some of the employment surveys that show a job growth of about 1.2 million jobs. That's this orange line. That's overall employment and employer surveys. But the household survey really shows that this hasn't changed. So what is this graph telling you? It's telling you that you have roughly 100,000 more jobs or households that are participating in the labor market, but those people are taking on more jobs. And so that second job that they take on, or that third job that they take on through that payroll survey, is paying them significantly less. And that's what's driving some of the decrease that you're seeing in the labor market, especially as it pertains to wages. So the question is, where does this go from here, and what are the adjustments that the Fed needs to make as they start to look at the options that they have available to avoid a potential recession? And I think, Jared, the other thing is, if you look at where GDP is, I know we're concerned about recession being a possibility, but again, the numbers that were reported just last week, looking back a full quarter, was in the high 2% range, and the expectations, at least through today, based on the Atlanta Fed, is still positive economic growth.
And when you look at that, David, now with the landscape, we're not likely in the start of a recession based on what we're seeing. That can quickly turn, and this is sort of the skill of the Fed. How much do you anticipate the slowdown versus waiting? And it's a real challenge, because when you look at expectations from interest rate perspective, it's changed fairly dramatically, and there's been a ton of volatility this year. We started the year expecting the Fed to cut interest rates as many as 6 times. That got as low as 1 rate cut. And now recently, based on this turmoil within the markets and the anticipation of slower economic data, when you look at kind of expectations between now and the end of the year from interest rates and looking at next year, there's a dramatic difference on, what's ahead. So David, if you could pull up the interest rate projection graph, you can kind of see the dynamic. Whether it's the market trying to force the Fed's hand, which is the orange line, this is market expectations, versus, kind of stated Fed projections is the blue line. Both of those over the next 15, 18 months, are going lower. So right now, Fed funds is at 5.5%. Both the market expectation and the Fed are projected to cut interest rates now in September. But now the speed and how many cuts will happen is the difference. But in some sense, it doesn't matter all that much, because now we enter a different era of investing. We've been in this higher for longer, over the last year and a half or two, and there's been a lot of activity within the growth markets. Now, as you look ahead, the question is, who benefits from a lower interest rate environment, and what are the things to look for, between now and the end of the year and into next year? Because, one of the big ones, David, people sitting on cash, right?
Yeah, so if you're sitting in cash, and that's one of the areas of opportunity is, what do you do now in the face of potentially lower interest rates? And those can happen at the short end of the yield curve, so as the Federal Reserve moves to lower rates. But that's also going to have a downward impact on the longer term rates as well. So one of the options and one of the things that you can do is, just to extend duration, lock in some of the certainty where you want to have a consistent portfolio that generates the income that you need. The other areas we're going to take a look at are going to obviously be tech, right? So tech, had a lot of momentum into the early part of the year. Historically, tech companies, are supposed to not do as well in a rising interest rate environment, partially because of the financial models and the discount rate. But one of the things that's benefited them greatly is the amount of cash that they've accumulated. And so if you're a tech company and you have $100 billion of cash on your balance sheet, like some do, um, earning 5% generates $5 billion of profit straight to the bottom line. As that goes down, you're going to start eroding the profitability of some of those companies, and it'll create an opportunity to rebalance, to really identify the quality within growth. So is the growth happening because of higher interest rates, or is the growth happening because they're actually able to generate additional revenue and income from ongoing operations? And so that'll be an important distinction to make. But the other sector that stands to benefit too is, at some point, and it's still too early as you look around commercial real estate, but at some point, the broader real estate market will stand to benefit as well, because again, as rates move lower and as some of those deals can get priced and you can have a more reasonable interest rate on some of the transactions, it creates more opportunity. It creates more supply, with sellers being more willing to sell, to move on to another place where they can get a lower rate mortgage. So it will create a lot of opportunities as rates move lower, but you do want to be tactical within your portfolio and adjust based on the needs that you have, at least to the extent that you can foresee them.
Look, the question is always is where do you go from here, right? Given the uncertain landscape we've seen over the last, few weeks in the market, especially the last week, it sure looks like the momentum, has definitely faded. So looking ahead, with the Fed likely to cut interest rates on a slower labor market and other items, valuation we think is going to matter a lot more than momentum. Whereas before, if I could sell more, grow my revenue, keep expanding, that's been very much in favor. But now as things slow down a little bit and growth rates start to slow, valuation is going to matter. So you're likely to continue to see more rotation around that, whether it's dividend stocks, whether it's, middle to modest PEs overall. And then the bond market continues to be steady overall. So I think as you think about your portfolio, still not a bad time to consider rebalancing, even if some of the momentum names have come down. We think that 60-40 type of allocation over the next year and a half or two is probably going to be a good defensive play, if we hit more of a slowdown. So I think valuation over the next 12 to 18 months is going to be a bigger item. And you really want to focus on where things are on that side of the portfolio. So with that, we want to thank you for tuning in, and we'll touch base in September.